Alright, what's up everyone, and welcome back. Today, I'm feeling much better. Yesterday I was completely dead. Now I feel amazing. So, in our last episode, we talked about the most crucial part of the trading, that is the logic behind every trade and the most powerful pattern of all. That is when to stay out of a trade, when to not take a trade. So now you should know how to find an actual high probability reversal, and when the trade just doesn't make sense, and when to just skip on it, right? Not take the trade. And so today I'm going to talk about the continuation model for re-entering a move, because let's say you missed the initial reversal, or what if the move starts and you want to get back in. So today we are going to talk about how to re-enter a move that's already in the progress using the continuation model. So up until now we have been focusing on these reversals, getting right at the beginning of a big move, the turtle soup, the SMT, the filter swing. No, I haven't made the video about SMTs yet, which I will do. And but let's say you missed the entry at the start. Okay, you kind of missed it, and like, oh damn. And then you maybe make a dumb decision, right? Just like enter one tick stop loss. Of course your stop loss gets hit, right? So you need to have a little bit of a patience and actually wait for it to reverse. If it doesn't, I mean, like to reverse, to enter on it, and then just ride with the trend. Because if that doesn't happen, then just don't enter the trade, right? You don't want to take that type of trade. And that's what the continuation model is for, right? So the pullback entry works as, let's say, after a strong impulse move, the algorithm will often pause, and it will make kind of a small pullback before it continues in the same direction. Think of it like a quick, I don't know, like a gas rest stop on a long road trip. And this isn't a reversal. You don't need to be entering short when it happens. If we are in a bullish market and it starts reversing, we are not entering a short, right? Because we are following the trend. That's just a little pullback, and you need to wait for that perfect opportunity to enter a long, not a short. Your entry is going to be at a specific key level or a consolidation zone after that, the initial push, right? So your entries and stop loss. So there are a lot of confluences you can use to actually find a continuation model, enter on a continuation, I mean. And the most, I'd say the best ones is the Fibonacci, the 50% zone, or the 79, the golden zone, or the fair value gap continuation. That is also a really good model. You are going to be looking for a clear, strong move followed by a shallow, clean pullback. Your entry is as the price confirms the continuation out of that pullback zone, and you will place your stop loss below or the low of that pullback, or above the high in a downtrend. And of course, your target is still going to be that consistent 1 to 3. I'd say the minimum is going to be 1 to 3. You can go for 1 to 4, 1 to 5, but I'm saying 1 to 3 is really good. Again, you can have a 40% win rate. You are still going to be profitable if you have a 1 to 3. If a 1 to 3 is not possible, then a 1 to 2 is okay. If it's a 1 to 1, then it turns to a high risk, low reward. Because I don't think anybody enters, let's say you have a 100K account, you are not going to enter a trade with a 1 to 1 with $200, right? You're going to enter with like minimum $500, right? And once you lose this, what happens to your brain? You are not satisfied with the loss, right? You are hungry, let's say like that, okay? You turn into a gambler, and you start making dumb decisions. So that's why I 1 to 3 is good. you can go with like, let's say $300 and make $900, right? So if you lose that $300, it's really nothing. But yeah, 1 to 3 is going to be the best case scenario. 1 to 2 is also okay. And 1 to 1, well, yeah, it just turns to a 50-50, right? So the anatomy of continuation, right? So what do we see here? We have the classic accumulation, manipulation, distribution, right? So step 1, the impulse move. After the manipulation has happened, what is going to happen? A distribution. So we are going into an uptrend. Step 2 is going to be a pullback to a key zone. So that is right here. We can see a pullback. So step 1. Step 2, the confirmation entry is going to be step 3. So either we have a fib zone, maybe this is the 50%, or there was a fair value gap, let's say. And step 4 is riding the trend, and we are continuing to go higher. So let's look at the first example that was on Friday. I didn't take the trade. I've already talked about the trade, but I didn't talk about it like this. So, okay, let me just remove everything right here. So, I am on the 5-minute time frame. And what can we see? We see a order block right here, right? We see this. That's an order block. What else do we see? We see a fair value gap. It's also right here, which is being respected. Because if the next candle would have closed below this candle's wick, then it would disrespect it. But as you can see, the next candle went bullish, but we already kind of missed this impulse. So what kind of else confluences can we add? We can add the Fibonacci. So we take the low of this wick and drag it to the top of this wick right here. And you can see what the price did. The price went into the 0.69 zone. You can copy these settings for the Fibonacci. The 50% zone is the most important. The 79, 69, the golden zones. So you can just copy these settings. And basically, you could just, let's say, enter trades like this. Yes, this can also work. So if you have something, some kind of a target, you can target it by putting your limit order, but of course that is risky. So I would not recommend to do that. You need to backtest it. So this is for the first example. You can see this is a continuation. Okay, so let's jump over to the second example. Here again, 5 minutes. We have higher time frame buy sell liquidity that is right here. And what do we see right here? We have this key level right here. So again, we have a fair value gap right here. You can see these candles inverted. So could have entered already right here. 9:30, you can see the market, right? Same thing again. So let me remove the fib zone. So you can see what is happening, right? We were in a bearish market, so manipulation took out all of the stop losses. And what is happening next? Distribution. So once this happens, if the price starts styling a bit, right? You just take. I don't know how to use. Okay, so if price was going like this, and then it just kind of started doing this, right? Then you should be taking your fib, taking the low, or either this or this. You need to be looking at the situation, but usually this one. So then you need to be taking your fib, taking the low, taking the high, and looking where the price is going to go head to, right? So it is exactly the same in this situation right here. So you take your fib, take the low, take the high. Where did the price go to? 50%. And retraced back and went up. But also, did we have right here a fair value gap? The fair value gap is being respected. So already two confluences, right? The 50% fair value gap. Distribution, literally you just enter like right here. Once this has happened, put your stop loss like right here, and target the buy sell liquidity that is up right here for 298. And you can see what it did. Took out the higher time frame buy sell liquidity, and then kind of reversed. So same thing again. Fair value gap, Fibonacci zone, the 50%. Fair value gap, respected. So okay, let's move on to the next example. Really similar scenario. So we have a higher time frame buy sell liquidity that is right here. Let's check what is going on market open. So you can see a similar situation again, right? What did the price do? Go into the 69%, 69 zone, and reversed and went up higher. So again, we have a fair value gap right here. If we look, what's this zone taken out? So the price took this sell side liquidity that is right here, right? Also, there was a fair value gap. I mean, you can add rejection blocks and etc. But I'm not going to overcomplicate this course. So we have a fair value gap. This is on 630, so could have entered right here, but of course we are trading the New York Open. So we took this higher time frame liquidity sell side. That's already giving us confidence. So it's just that the price is going to go higher right now. Once it respects this fair value gap, once it disrespects this fair value gap and key level, right? What do we see here? Turtle soup, right? Now let's look what is going on right here. So we inverse this fair value gap right here. Again, you can see what the price is doing. It was going in an uptrend, then it kind of stalled, started going down, respected this fair value gap, started going down, so could have scalped right here, but I'm not into scalping. So again, we take the Fibonacci, we take the low, take the high again, and what happened? Price went into the 50%, went up a bit higher. What did the price do next? Fell down again, touched the 69 zone, the 69 and the 70, and oops, sorry, that is not what I wanted to do. So basically, if you're a crazy guy, you could have entered right here after this candle closed, so on this candle, and targeted the 0% for 3.6, right? So this becomes as our protected low, and you can see again, right? Took this low out, turtle soup, on a small time frame. So took this low out, turtle soup, fair value gap, inversed it, went up in an uptrend, stalled a bit, went down, touched the 69.79 zone, the middle of it, and what did the price do next? Went up higher and took out this high time frame buy sell liquidity. This is also a good one. Well, it's not really the best one, but because the price wasn't the best during this day. But look what the candle did on 925. Went up, swept off of this liquidity. There's right here. Respected this fair value gap. So basically, once this candle closed, you could have entered the short and targeted this liquidity right here, right, for 2.8. So let's look at yesterday. Yesterday I didn't take a trade because this price is absolute garbage. But what we can see from here, we have this higher time frame drop on liquidity right here. So buy side, right? So this is 26th August, and what can we see from here? We can take our fib, take the low, take the high, like right here, right? So let's say you kind of missed this opportunity right here. What did the price do? Went down, touched the 50%, you can see reversed, touched the 0%. What did it do? Went again, touched the 50%, and what's next? Again went up. So actually this day was complete garbanzo. You can call it support and resistance, whatever. You can see like what is this, like how are you supposed to trade this, right? So but you can just go and play around with the fib, backtest it, see how the continuation works now. So these are the two main things for a continuation. Of course you can add order blocks. Okay, no, let's just stick with these, right? So these are the three main things. I'm not going to explain how do they work, because I'm just making this video if you know something already about trading. So I think you know about fair value gaps, about order blocks, and about fib. I kind of explained it already. And yeah, okay, I actually want to find a downtrend. Yeah, maybe we can test this out. So take our fib again, take the high, take the low. If we were bullish, again, we take from the low to the high. If we are bearish, take from the high to the low. Now again, what did price do? Went up, touched the 50% zone. Okay, maybe it's a little bit hard to see. So 50 zone. So right here, the 50% zone. Do we have a fair value gap? We have a fair value gap right here. You can see which is being respected. This candle closed above the fair value gap, but none of these candles closed above this candle's wick. So usually after this happened, the 50%, you could already basically enter on this candle, put your stop loss above this, and if you are in the downtrend, then sure, target this low, right, for a 3.5. So that was for the downtrend. Maybe if we can spot something more. Here, what happened? We went into the 79%, right? So here we are in the ranging, kind of the price didn't want to go anywhere. Took the 50%, chilled into the 50% and the 279 zone. And basically after this kind of closed, again, entry right here and target the low. Because the 79% is a lot better, because that is the golden zone, than the 05. But still, if you catch trades in the 79 zone, 69 zone, that is perfect. Still, if you catch them in a 0.5 zone, because that is also what needs to happen, and you are doing everything correctly. So that was it for this video. Tomorrow's episode is going to be about the importance of the AM candle. So hopefully you learned something new about the continuation model. The most important thing is to go and backtest it actually. Yeah, that's basically it for this video. Hopefully you enjoyed this video. Make sure to like the video, subscribe, and I'll see you in the next video, that is tomorrow. And probably I'm going to break down also the trade that if I will take today in tomorrow's episode also. Yesterday I didn't take a trade. So anyways guys, that is it for this video. See you tomorrow. Goodbye.